This episode is brought to you by 180 Markets, where it is our goal to bring every individual, fund manager, family office, or any qualified investor access to Australian Stock Exchange capital raises. If you are ever interested in how to access ASX capital raises in a super simple way, 180 Markets is for you. The sign-up process is easy. You just upload your ID, proof of your investor status, and your current brokerage account information. The settlement of shares goes right into your existing account, and you can access our very next capital raise. If you're interested in free, easy access to thousands of ASX capital raises, including placements, IPOs, reverse takeovers, and more, check out 180markets.com.au. Hello, everybody. Welcome to another edition of 180 Markets Pro Investor Series. Investors, as you know, Sean and I are professional investors ourselves, and as much to understand about what other people are doing selfishly, we also want to offer that opportunity to you, especially when we find managers that are doing things a little bit differently than everybody else. We can always learn something. The markets are so dynamic, and it's just exciting and interesting to hear other people's stories and how they view the world. And with us today, we have a small cap Australian manager, Ron Shamgar of Tamar Asset Management. And Ron has had one of the best track records in small caps over the last number of years here. So certainly he is doing something right. And with that introduction, Ron, welcome to the show.
Thanks, Greg, and thank you for having me.
Hey, Ron, the markets are a beast and they're always dynamically shifting as we discussed. Can you just tell us a little bit about your thoughts on the markets right now?
Well, look, it feels like a bit of a tug of war at the moment. You know, you've got the earnings that are actually been quite strong relatively, both here in Australia and in the US. You know, companies have done quite well. I think we've had a sharp sort of V-shaped rebound in economic activity and growth from the pandemic. You know, the US, the UK, and obviously Australia is a bit different, but the vaccination rollouts has gone really well. So their economies are reopening. And on the flip side, on the other side of the tug of war, you've got investors starting to get concerns about inflation. There's no doubt that inflation has emerged. You know, we've seen asset prices, commodity prices, really gone up a lot, and that's starting to put pressure on cost of goods for many companies, and they're going to have to pass that on. So we've seen a lot of commentary about inflation, and we've seen the inflation numbers for April in the US. So investors are starting to get concerned about, the central banks around the world tapering their essential money printing and potentially even raising rates down the line. And that's obviously has an impact on valuations and, mostly on that sort of growth, stock valuation sort of impact. So, I think that's what's happening in the market right now. But, we try and sort of avoid taking too much of a macro view. I like to focus on, the fundamentals of each business that we're investing in. And we're trying to find a company that's going to keep growing regardless. And if we can identify those companies in sectors that will continue to do well, then I think that, the noise in the short term, you can have volatility, but over time, the fundamentals shine. And if the company is worth more, the share price eventually follows the intrinsic value of that business.
Absolutely. And you touched on a good point just there about the difference between, trying to find individual stocks. And you also mentioned sector. Do you tend to look at the sector first or the stock first?
Yeah, so I know some investors or fund managers, like to take that top-down approach. I personally like to actually look at individual companies, so regardless of the sector. But because there are so many different sort of industries and sectors and companies out there, you tend to have quite a diverse, a portfolio of stocks anyway over time. We tend to usually own between 30 to 40 stocks in their portfolio. So we're looking for businesses that essentially, obviously there are certain characteristics and features that we like, businesses that have some sort of recurring contracted revenues, ideally profitable. We want them growing the top line as well as the bottom line, and businesses that are ideally cash generative, don't require a significant amount of capex to grow. But then we also want businesses that are operating in industries that have tailwinds, then potentially disrupting an existing industry with a better or more efficient solution or product. And then because I focus more on that small cap end of the market where I think I can add more value to investors. I get access to the management teams rather than, no one's going to talk to me at CBA Bank or BHP. So I get more access and I get insights into these businesses. And you're looking for these companies that have management teams that have a track record of success, people that you can actually trust, and you can sort of, understand what their vision and their strategy is for a business. And I think if you understand that and you really like what you're seeing and you can really see where they want to take the business to, then that's actually more important than everything else. That the management in that smaller end of the market is really key.
I couldn't agree with you more, especially because, and again, at the smaller end of the market, where it's very, very hard to tell what a company is going to truly look like in 5 years. But what you do need to do is to back a manager that can move and shake and do the things that are necessary to steer the ship in the right direction, so to speak.
Yeah, definitely. And, I guess there is obviously an element of you can sort of check their resume, so to speak, and their track record, and you can see past success. But a lot of the times, I guess personally, having been doing this for the last 18 years, you do tend to kind of like get to know people in the industry. So, certain directors on the board or certain management teams that have gone from one company to another. And you remember, yes, these guys were really good. They made us money. And these guys, don't get close to them because, it's always been a disaster. So I think time in the market experience does help, identifying these people and sort of remembering what's happened in the past.
Absolutely. You want to have somebody that's a real go-getter as opposed to a lifestyle guy, if you know what I mean.
Yes. Always check their Instagram feed. If they're posting photos on a big yacht or something, it's a red flag.
Right. Chances are there was a great book, I think it was from years ago, where like where are all the investors' boats or something like that.
Yes.
Absolutely. And you mentioned some of the companies or some of the characteristics that you look for. Certainly, within finance, especially, there have been major shakeups over the last number of years with buy now, pay later, and non-bank lenders. And you mentioned also about disruption. Do you see those two sectors in particular, continuous growth?
Yeah. Look, so definitely, there are disruptive sectors out there. I mean, I think the buy now, pay later sector is probably one of the biggest disruptions, in the finance industry for the last, I don't know, maybe 20 years more. I mean, essentially they're replacing, the credit card market to a new form of sort of budgeting installments for that younger generation that really likes to sort of budget everything they spend. And, the opportunity is massive. And, the market leader is obviously Afterpay, and they've done really well going overseas. And what happens in these industries, they are sort of, obviously it's a good growth story, but all these sort of companies in the sector, they tend to go, they all tend to go on that sort of momentum run as they keep growing and outperforming investor expectations. And what happens is the sort of valuation of the market leader becomes the benchmark for the valuations of everyone else. So Afterpay, when he was trading at $150 and 35 times revenue, then the next company, like Zip, was trading on 15 times revenue, then wow, that's cheap, right? So everyone buys that up. But what happens when that sort of momentum sort of eventually comes to an end, and then the expectations sort of that these companies cannot continue to outperform expectations, even though they're still growing. And then you have a bit of a shift in sentiment for valuations and tech sector and so on. Then you see, these when the market leader starts sort of dropping off, then everyone else follows, and suddenly, when they're on 20 times or 15 times revenue, then you're never going to get that 15 times or revenue for the second and third player. So look, the way we looked at it, sort of like last year, for example, and it was a bit of an extreme year, but we really focused after the March meltdown and the lockdowns on so-called COVID winners. So, companies that were going to benefit from the environment of people staying at home and so on. So, for us, we really switched into the e-commerce businesses that were selling to people while they were at home. Telco businesses providing, businesses, the ability to work with the workforce remotely. Payments companies, nobody wanted to touch cash, so payments businesses, and then you had the buy now pay later companies as well, which were benefiting on the back of the e-commerce trend. So we bought these companies, we did really well, and then what's happened towards the end of last year, the COVID winners started becoming the vaccine losers, as we refer to them, because things were opening up and people don't want to stay at home anymore, and they don't need to shop online, so they're all going out. So so we really switched into more bricks and mortar retailers that we felt were doing really well. I think payments companies still did well. We exited the e-commerce sector and we exited the buy now pay later sector, and then we started buying that sort of what I call the reopening trade, or the vaccine winners, which are, say, travel related stocks, but not necessarily travel related stocks that people think about like the Webjet and the Flight Centers of the world. We don't really see any value there. We focus more on people in Australia, for example. They're looking to take more domestic travel, they're looking to avoid public transport, so companies that provide tires and wheels and mechanical workshop repairs for cars, companies that provide consumer finance for buying vehicles, and so on. So we focus on those kind of businesses rather than the sort of more obvious ones like booking flights overseas.
Absolutely. And it's also one of the reasons, because sometimes some of those companies can become what I call battlegrounds, which is when you look at, as an example, like an Afterpay now, the stock has come back a lot, but it becomes like what I call a battleground, which is it's probably something between growth and value price. It's starting to make a stand, but it's very hard to really know, is this it or not? Whereas, say, like, as you said about like, when you look at like, auto repair companies or tires or something like that, tire sellers, you just know that there's big demand out there, and there just may be like easier ways to express that view.
Yeah, definitely. And obviously a lot of these sort of growth tech stocks, that while they were growing really strongly, the top line, they were always running losses. So it's very difficult to value these businesses. So you really kind of use like I said, a sort of a revenue multiple, which is quite powerful on the way up, because as the multiple expands on a bigger revenue number, the valuations can really go hard, which we've seen. But it's kind of like the same on the way down as well. Whereas other businesses that I talked about, they're usually all sort of profitable, making profits. So you can value them an actual sort of multiple. You can actually look at the sort of dividend that they're paying, and you can look at the yield. So there's a lot more sort of, I think, easier benchmarks to value them, which I think kind of give you a bit of downside protection. If a company is paying you a 5-6% dividend yield and they're really profitable, your downside is not huge, unless obviously they disappoint investors' expectations. But Afterpay, you could argue that it's probably it could be expensive at $30 even, right? I'm not saying it's going there. I'm just saying that there is no kind of benchmark to value it, because it actually makes no profit. So it's a little bit more tricky.
Absolutely. And you spoke about before, like the traditional, maybe measuring something on a cash flow basis or something where you can really point to it, or a dividend. Is that also a characteristic that helps you stay with a company when, let's face it, at times, if you're an investor, share prices are going to be moving against you, and it really can test your inner conviction? Does that give you a little bit more of a willingness to stay in the pocket with certain companies?
Definitely. But I mean, for us, in this game, it's I always say it's nothing personal, it's all business, right? And I think you cannot get attached to any business or any company or any management team, and you really got to focus on the fundamentals. So if the business is doing really well, and the market is just kind of selling off for no particular reason, and the share price drops, and that to us is just an opportunity to add to a business that is just getting cheaper. But if it's not necessarily like an overall market sell-off and a stock gets sold off for no particular reason, then you actually want to kind of dig deeper and understand what's happening, because surprisingly, usually the smart money always knows something that you don't, and you really got to dig, and you got to call around and speak to investors, speak to brokers. What are we missing? Speak to the management, and you really got to sniff out, what's going on. And then if there's nothing, then it's an opportunity. But sometimes maybe there's some bad news coming. But but if a company does disappoint, or for example, they don't meet investor expectations, or the fundamentals have changed, we actually have quite sort of strict rules on how we sell. So whether the fundamentals have changed, whether it's become too expensive, or there's better opportunities elsewhere, is sort of the real reasons why we would sell or take profits in a business. So you got to kind of like look at everything that's going on, and just because the share price is dropping, it's not necessarily a signal to buy.
Absolutely. And I'd love to spend a little bit more time talking about selling that you've just discussed, because to me, I think that one of the most under-discussed elements of investing is selling, for sure. There are lots of people to talk about their buy list, but not many people talk about their sell list. You touched on when the fundamentals change. Can you just go into a little bit more about your selling strategies?
Yep. Yeah, you're right. Look, buying is easy. There's always a good story. And when you talk to management, they always sell you some blue sky, and brokers tend to be
very
biased.
Good.
Yeah, brokers, always tend to be biased on the buy side. So, look, we have three sort of strict policies. So the first one, the fundamentals change. So, when you buy a business, you buy it because you expect it to do a certain amount of profit or revenue growth, and so on. And you might expect it to win some contracts or whatever. And, if those fundamentals sort of don't meet the initial criteria, then that could be a reason to sell. The other reason is, if the company along the journey maybe made an acquisition, took on too much debt, maybe paying up for acquisitions, becoming a bit too aggressive, might have a concentration on one particular customer that, you're getting concerned about. So there's all kinds of reasons that may change the initial sort of thesis of why you bought into the business. That is definitely a reason to sell or reduce. And then obviously, when we buy these businesses, first of all, we have to tick all the qualitative aspects of the business, cash flow, recurring revenue, like I mentioned, the management team, and all kinds of financial metrics, the balance sheet. But to us, we're trying to value the business. So we're really, by talking to the management, we're trying to, what is this business going to earn in a couple of years from now? And then we're trying to value it. There's a few methodologies, but I always say sort of, I'd rather be sort of approximately right than precisely wrong. And essentially it means that it doesn't matter if the business is worth $1 or $1.10 or $1.20, it's irrelevant. You're trying to buy it at 50 cents. Because your margin of safety will take care of that sort of, valuation, because, even some companies don't really know what they're going to earn in 2 years. So, how am I as an outside investor? I'm kind of kidding myself if I think that I know better than management. So to us, if we're buying a stock at 50 cents and you think it's worth $1 and it gets to $1 quite quickly, then, probably the risk reward is no longer there, and we will look to sell. Now, if it's a really good story, we might not exit. We might just take significant profits. And then, we might keep a small position. And then if it just becomes way too expensive and there's better opportunities out there, because at the end of the day, we don't want to own 80 stocks. You want to stick to 30 to 40 stocks. It's a good balance between sort of, having conviction and having some risk diversification. So, you have to kind of decide, maybe there's a better opportunity or upside in another stock. So that would be another reason. But there is another rule, which is very difficult to quantify.
Sure.
And I call it feed the ducks when they're quacking.
Yes.
And basically, it's almost hard to kind of, set kind of parameters around this. But when a stock does really well and everything goes to plan and the share price is going up and, all the brokers are increasing their price targets and everyone's talking about it, and even you yourself become even more bullish on the stock, and suddenly you're trying to kind of like increase the valuation of the business because you want to justify holding it or buying more. It's almost like the ducks are quacking, they're hungry, and it's time to feed them, which means it's time to sell regardless. And that's kind of like something that only experience over time teaches you to identify these sort of moments. And it happens for every stock, and so you kind of gotta kind of, when everyone's sort of bullish about it, I think sort of it's just regardless of everything else I just said, you probably want to let some go.
Yeah, absolutely. We couldn't agree with you more. I know that one of Sean and I's golden rules is that you have to sell into liquidity, especially when it comes to small cap companies. And the other thought is, and I'd love to get your thoughts on this. We tend, investment mistakes, because this is a much about not just what you like, but how do your process. We notice, and we're still doing it after 20 years, when we say to ourselves, this is the one, that is generally a warning sign, an internal warning sign. Whereas when we say this is another one of those, that tends to produce our best victories. We just don't know which ones they're going to come out of. Do you have any thoughts about that as well?
Yeah, I mean, look, there's no doubt that one thing I've learned over the years is that, especially when you're managing other people's money, so in a fund situation, as much as you're bullish about a story and about a company's prospects, and you really think that this is the best business out there and the opportunity is so good, and you feel like you understand it more than anyone else in the market, it's still not worth risking too much on it, because as you said, there's always something that comes out of left field that you don't really know. And sometimes the ones that you kind of like don't think too much of, they actually do outperform. They actually give you the best sort of alpha out there. So I agree. I mean, definitely have conviction, but don't take, excessive risks. So I see some funds maybe take 10, 15% positions in companies. To me, that's just too risky. I've seen it too many times where a stock can drop 50% on bad news, and it's just not worth it. So I think having that portfolio allocation and knowing when to trim, and just don't bet the farm on one stock, and especially when you're managing other people's money. I think when you're managing your own money, I guess you can kind of live with your own stupid mistakes.
Absolutely. And is that where also in your mind, you have had outstanding performance, and is one of the reasons because you are able to strike that balance between diversification and conviction, and that this way, you don't get sometimes what, great performance could be determined as much by not losing so much as victories. And is that maybe one of the things that you've been able to, dare I say, do pretty well?
I think the key really to strong performance over time is actually not necessarily picking the best winners. I mean, sure, you got to pick stocks that go up, but it's just avoiding the losers. And really, I think I've joined Tamim 2.5 years ago, and we had obviously very strong performance since I joined, about 40% per annum after fees. But it's just really, I think I've managed to avoid the big losers and the massive downgrades in the market over the last few years. And don't get me wrong, I have got hit over the years in my past life, in my previous fund, and I've learned from those mistakes. As you mentioned before, I think sort of betting too big on a few positions that you really think are going to do well, and then something comes out of the blue. So it's really about, so what we actually, I tend to do is I try to identify short opportunities, so companies that are going to disappoint. And we don't short in the fund, but by identify businesses that I think will disappoint, it helps me avoid them. And it sort of helps me maybe avoid other companies in the sector as well. So for example, I've been saying for quite a while that, with the borders closed in Australia, that we don't have those daigous anymore, those Chinese travelers, students, and so on that would come in here, buy the baby formula products and all those things. And then, so I think, I've been saying A2 milk, I think the valuation seemed too high and I just couldn't see them doing well. We're having no daigus, and, that helped me avoid the entire sector. And we've seen A2 milk really disappoint and downgrade recently. So by avoiding these businesses, I think that's really the key to outperformance.
Ron, that's an amazing point you just pointed out, that even if you're not a shorter of stocks, it doesn't mean that you shouldn't look at the market from the short perspective, because as I'm sure you know, shorting stocks is a very different beast. And but the research perspective that you're bringing is really, really, really important. So
that's definitely. And look, maybe we could have made a lot of money on the short side, but it's just more to help you on the long side.
yeah, no, and that's what I wanted to point out is that whether you're, even if you're somebody that says, I'm long only, I never short stocks, it doesn't mean that you couldn't have a variant view that can help you just avoid those losers.
Yeah, for sure.
Absolutely. Hey, Ron, before we close, I just wanted to also just talk about the emotional makeup of an investor, because as I learned, you can be a very, very smart person, but on Wall Street, unfortunately, there are a lot of very, very, very smart people. But a lot of times, do you have a certain emotional makeup, do you think, that are superpower or avoidance of things that just helps you?
Yeah, look, I mean, I think over the years you do, although I don't think you can take out emotion from investing.
No.
I think there's always an element of emotion in investing, and it is a bit of a roller coaster ride and the ups and downs, and I mean, especially over the last, over the last year or two with COVID, I mean, that's been one hell of a roller coaster ride, um, but I've been doing this now for 18 years, so I've seen the bull market up until 2007, and then I've seen the GFC, which was a cakewalk, by the way, compared to the COVID meltdown. And then I've seen sort of between the GFC up until COVID, I've seen all kinds of corrections and market worries and ups and downs, and then we saw COVID, and I saw the bull run since COVID. So you really gotta take emotions out of it, and that's why I think you set certain rules, like when it comes to selling, you got to stomach volatility, because at the end of the day, investing, it's volatile, right? Like, who knew COVID is going to come, and who knew the world we're going to shut down and we're going to get locked down and the market will tank by 40-50%, and then so you got to be able to do that and just sort of focus on the fundamentals. And like I said, again, don't let emotions get in the way. So don't fall in love with a company. It doesn't matter how good it is, doesn't matter how much you like it, just don't fall in love. If it disappoints, sell, move on to the next one, because I promise you, management, they're not falling in love with you as a shareholder, they're only looking after themselves as well. So keep that in mind. And yeah, I think also as a someone who's more, I guess, in social media these days, you got to have a bit of a thick skin, like
Yeah,
social
absolutely.
media can be quite brutal, and you might have a bad run, whether it's a bad month or maybe a bad year or so on. And don't let people talk get into your head or get under your skin, and just focus on what you're good at. And eventually fundamentals do follow, and share prices kind of follow fundamentals, and eventually the real value of a business comes to light over time.
Absolutely, Ron. Thank you so much. I really think that was incredibly insightful on just both the fundamentals, the emotional side of it, how to, and especially the selling. Any closing words for the audience?
Yeah, look, I think generally, I think investors should always have exposure to equities, and I think try and really just shut out the noise. The media, the newspapers, they're always fishing for a story. Just shut out the noise and focus on the fundamentals of the businesses that you own, and the rest will just take care of itself. That's the best advice I can give.
Absolutely. Thank you, Ron. And for everybody that's watching, I'll put links in the show notes about where to find Ron, both on all his socials, and to find Tamim. Ron, thank you very much.
Thanks, Greg. It was a lot of fun. Appreciate it.
Bye-bye.
Cheers.
Thank you for watching another presentation by 180 Markets. Don't forget, if you want access to thousands of ASX capital raises, head on over to 180markets.com.au, sign up, and get on board for our very next capital raise. Thanks for watching.